Today's lesson will be Chapter 16, Problem 3B. I'm sharing with you an Excel spreadsheet that I've made up for Problem 16, 3B. What we're going to be doing is in a statement of cash flows using the indirect method. What you're looking at is a comparative balance sheet for the years 2001 and 2002. They've given you a balance sheet, and in this problem, they actually give you examples of ledger accounts that are completed with additional information that you need to be able to create a statement of cost of goods manufactured. All this is additional information. The first step that you will do when you're trying to solve this problem is like we did with the other problems. You'll want to compare what is current with what happened last year. We'll want to find either an increase or decrease in each one of your balance sheet accounts. So you will take the amount from 2000 Y2 and subtract the amount from 2000 Y1 from it to give you either an increase or decrease. You want to do that for each one of these accounts. That would be step one of computations before you prepare the statement of cash flows. Normally, our step two is to create journal entries from additional information. In this problem, you do not have to recreate the journal entries. They've already created them for you in each one of the ledger accounts and have posted the journal entries to the ledger accounts. So we're going to start the statement of cash flows like we normally do. We would start with our operating activities. Because this is an indirect method that we're using, we're going to have to convert the net income to the cash basis of accounting in the operating activities section. Before you prepared a cash flow, the net income was calculated according to the accrual method of accounting. And we need to convert that, we need to adjust it to the cash basis so we can actually see the cash that flows in and out from our operating activities, which would have affected the net income. So we're going to start with the net income amount. And as they have in all the problems, they have given you the net income amount. They did not show you an income statement. You would get this amount from your income statement, but there's another place that we can look for it in the retained earnings. Do you see here in the retained earnings ledger account, they have net income showing as $326,600. So this is where I'm getting the net income that we need to convert from the accrual basis to the cash basis of accounting. To adjust that net income, we're going to start by looking to see what our depreciation expense is for this company. And our depreciation expense actually comes from two separate places. It's going to come from cell address D48 and cell address D64. Those addresses are the accumulated depreciation accounts that we have in our ledger account. So one of our accumulated depreciation accounts is on the building. And you can see here where they've written the depreciation for the year is 31,200. This 31,200 would be combined with the accumulated depreciation that was credited to the equipment account of 37,200. Both of those depreciation expenses would be combined together to get this 68,400. So we actually had some depreciation expense that would have been recorded on both of those assets. And so you figure out what's on sale D48 and add to it what was on sale D64, and that's how we come up with the depreciation amount. In this particular problem, there were no intangible assets. If we would have had intangible assets, they would have shown up in the asset section here. There are no intangible assets, so therefore there is no amortization on intangible. So that would be 0. Then we're going to look for our decrease in current assets other than our cash account. And so the amount that I came up with was 7,800. And this decrease is from the prepaid expenses. If you look at your balance sheet and compare the prepaid expenses on line 11, from year 2 to year 3, you can see that they've decreased by the amount of 7,800. That 7,800 is recorded here. It is a decrease in current assets, but to adjust the net income, we have to add it back. So that's why I didn't bring down the negative amount here. Just used a positive for this amount. The increase in your current liabilities, you're going to look for those, and it's in the income tax payable account. Again, we look for those in the balance sheet, and income taxes payable had an increase of 4,800. So that's where we're getting the amount from. So that's what goes there. For the loss on the sale of assets, we did not lose any money on the sale of assets. What you would have to do is look through your ledger accounts to see if we sold any assets. And if we did sell any assets, it would show up in the asset accounts that they have pictured. We did sell an asset account, but we didn't realize a loss from it. We actually sold land. I can tell that by what they have placed in the ledger account. Do you see that they said that they have realized $456,000? That means they've received cash from the sale of this land. Notice how the land account was credited. The sale of the land cost $396,000. And they got $456,000 for it. So this is not a loss, but it would be a gain on the sale of land. So there is no loss. I don't see that we have realized cash for any other type of asset. Realized cash means that we're receiving cash. So that's why we put a 0 in for the loss on the sale of assets. There wasn't a loss. However, there was a gain, so it would go under the next section. But since we're not there, there's no loss. Combine all of these together to get the total additions to the net income to convert it to the cash basis. The next thing we're going to look for is if we have any amortization recorded on our bonds. So we're going to look at the balance sheet accounts and look to see if we have any bonds. Well, we have bonds here, but I don't see any account underneath it. If we were amortizing, we would either be amortizing a discount or a premium on the bonds, and that would have to show up underneath this category. So what that tells us is that the bond sold at face value. There would be no amortization that we have to keep up with. So on our operating activities where it says amortization of bonds, we would record 0. On the next line, we're going to look to see if there is an increase in our current assets other than our cash account. And in this case, you can see I've recorded 147,600. This actually consists of 2 separate accounts. We had an increase in our accounts receivable, and we also had an increase in our inventory. So if you look at your balance sheet under your current assets, you can see that there was an increase in accounts receivable for 94,800, and there was an increase in our inventories for 52,800. The two of these together combined is how we come up with the increases in current assets. And those increases in current assets together make up 147,600. The next line we're going to look at is decreases in current liabilities. In this particular line, we have an amount of 37,200 because there was a decrease in our accounts payable on our balance sheet. So if we look at our balance sheet, the accounts payable, you can see that there was a decrease from 2,000 Y2 to 2,000 Y1. The amount of the decrease was 37,200. So 37,200 goes in for the decrease in the current liabilities. On the next line, we have a gain on the sale of assets. And in parentheses here, I've told you how they came up with that. There's a gain on the sale of land that is found by subtracting the cash paid for the land minus the cash realized. Cash realized is also the cash that we've received from the sale of the land, and that's $60,000. So you would analyze the land account in your ledger to determine that there was a gain. Then we're going to combine all of these together. The total deductions to our net income is 244,800. So this is our net income. We're going to add back our additions and subtract our deductions to give us the net cash flow for investing activities. Notice under the cash basis of accounting, the net income is now 162,800 after we've made adjustments for things that did not affect the cash during that period of time. The next section that we're going to be looking at is the investing activity section. And the first part of this has to do with cash being received from any investing type of activities. You might remember that investing type of activities are your investments in your non-current assets. Non-current assets such as plant assets or fixed assets, any non-current investments, any intangible assets are considered to be non-current. So this is going to be cash that we would record if we sell any of the assets. You might remember that we sold the land. We sold some fixed assets. We definitely sold land. But the land amount that we realized in cash is $456,000. And so that is the amount that would go into the cash that we've received from the sale of the land. On the next part, we're going to determine the cash that we paid out or that we used for purchasing investing types of activities. We're going to look through our list of accounts to see if we bought any fixed assets or plant assets, if we bought any non-current investments, if we bought any intangible assets. In this example, buildings and equipment were purchased. So we would have to combine the purchase price from the buildings and equipment. The sale address is right here in the formula. And the amount will be $1,186,800. We did purchase a building that cost us some money, and we purchased some equipment. So let's look at the ledger accounts to see where I'm getting this information. On the buildings account, do you see here it says that they acquired a building for cash for $990,000. That $990,000 is what the sale address is for C41. We purchased a building and we also purchased some equipment. We purchased the equipment for $196,800. This would be combined with the purchase of the building to get the total purchases of non-current assets. That will give you the amount of $1,186,800. The difference between what you bought in non-current assets and what you sold the non-current assets for is a negative $730,800. You combine your cash received with the cash that was paid out for investing activities, and you paid out more than you received. So this amount is a negative figure. Under the financing activities section, we're going to first look for cash that's received from financing activities. The financing activities could be from issuing long-term liabilities such as notes payable or mortgage payable. It could come from issuing bonds payable. It could also come from issuing stock. So if we look for this amount, we can see that we have received some cash because we have issued some bonds. You can see that on your balance sheet. You can see that the bonds payable account had 0 in it from the first year, but then it rose to $330,000 in the second year. So this $330,000 increase means that we have issued some bonds. You might also notice that we did issue some stock because there's an increase in the value of the stock, and there's also an increase in paid-in capital. But if you look closely at that, we did not issue that stock for cash. I'm sorry, we did issue the stock for cash. The total cash amount would be the par value, which is $140,000, plus the paid-in capital in excess of par value, which would have been $140,000 in this case too. So this and this combined, plus the fact that we issued bonds, there were three parts to this transaction. And all three of those together amount to $610,000. Look at your formula bar, and that will help you to see where that amount came from. So not only did we issue bonds, but we also issued some stock. So I'm going to highlight this here so you'll know that it came from the issuance of stock and the issuance of bonds. The issuance of stock and the issuance of bonds really has three parts to it, because stock has two parts. The paid-in capital and the par value combined together is the total cash amount that you would have received from issuing the stock. The stock that you issued, the cash amount, plus the amount you received for issuing bonds is $610,000. We're going to less out, or we're going to subtract from that any cash that we paid for financing activities. Any cash that we paid out, if we had repaid any long-term debt, which if you analyze all the accounts and if you analyze your balance sheet, we didn't pay back any long-term debt. But we did, however, pay a cash dividend. So this $79,200 results from cash dividends. Where I can find out the amount of cash dividends that we had was in the retained earnings account. Do you see here that the retained earnings account says that we have $79,200. That $79,200 is the dividends that we paid out. There was no treasury stock on this balance sheet. If we had had treasury stock, it would have been listed under stockholders' equity in one of the last lines here. There was no treasury stock, so we don't record anything about acquiring treasury stock because we didn't do that. The only thing that resulted here was we had a payment of cash dividends, and this comes from your retained earnings account. This $610,000 is cash that you received in, minus the cash that you paid out for the dividends, means that the net cash flow for the financing activities is a positive $530,800. That's because the cash that we received in was more than what we paid out. To determine the increase or decrease in cash, you would take the total of the investing activities, which is $162,800. You would less out the total of the investing activities. Excuse me, this is operating activities. You would take the operating activity amount of $162,800. You would subtract out, because this is a decrease, the investing activities, and then you would add back in the financing activities. Because you paid out more cash during this period of time than you brought in, there was a decrease in cash. Notice that's a negative amount there. So when you are recording in Cengage, if you have a negative amount for a decrease in cash, make sure you put a minus sign in front of that so that it will count your problem correct. To this negative decrease in cash that we had for this period of time, we're going to add the beginning cash balance. The beginning cash balance can come from the ledger or the balance sheet. In this case, it's coming from our balance sheet, the beginning balance was $337,800. Once you add the beginning balance to the decrease in cash for that period of time, the ending balance is $300,600. This balance will match up on your balance sheet. That's how you can tell that you've got it right. And so that's how you do the indirect method for accounting for cash flows. And that's all that we're going to cover in this particular chapter. So I'm going to stop sharing my screen now. And I'm going to stop the recording. Bye-bye.